Understanding the concept. Prepaid expenses represent assets acquired in advance, providing future economic benefits. To accurately reflect the expense incurred over time, we use journal entries and adjustments. Initial payment. Debit. Prepaid expense account, e.g., prepaid insurance. This represents the asset acquired and its initial value. Credit. Cash bank. This reflects the cash outflow for the payment. Monthly expense recognition. Debit expense account, e.g., insurance expense. This recognizes the portion of the prepaid expense used up during the month. Credit prepaid expense account. This reduces the asset value as the benefit is consumed. Calculating the monthly amount. The monthly expense amount is determined by dividing the total prepaid expense by the number of periods the expense covers. Example, insurance premium. January 1, debit. Prepaid insurance $12,000 represents the initial payment for a full year, 12 months of insurance coverage. Credit. Cash $12,000 reflects the cash outflow for the premium. January 31, debit. Insurance expense $1,000 recognizes the expense for 1 month's worth of insurance coverage. $12,000, 12 months, $1,000 per month. Credit. Prepaid insurance $1,000 reduces the asset value by the amount of insurance consumed during January. Explanation. By adjusting monthly, we ensure that expenses are accurately matched to the period in which they are incurred. Rather than expensing the entire $12,000 on January 1st, we recognize $1,000 of expense each month, reflecting the actual insurance coverage enjoyed. The balance sheet reflects the true value of the asset. As the insurance coverage is used up, the asset value decreases, reflecting the remaining benefit. Key points. The adjustment process is crucial for adhering to accrual accounting principles. The frequency of adjustments depends on the specific expense, monthly, quarterly, annually. Proper documentation of the journal entries and supporting calculations ensures accuracy and transparency. Prepaid expenses are recorded as assets initially. As the benefit is consumed, they are expensed. Example 1. Insurance premium. Annual payment of $12,000 on January 1st. Initial entry, debit prepaid insurance, credit cash $12,000. Explanation. We debited prepaid insurance because we are initially recognizing the asset, the right to insurance coverage. We credited cash because we paid cash for the premium. Monthly adjustment, debit insurance expense, credit prepaid insurance $1,000. Explanation. We debit insurance expense because we are recognizing the expense for the month's insurance coverage. We credit prepaid insurance because the benefit of the insurance is being consumed over time. Case studies, complex scenarios. Prepaid expenses can be found in various business situations, often involving complex scenarios. This slide explores 3 case studies illustrating the application of journal entries and adjustments for different prepaid expense types. Case study 1, annual advertising contract. Scenario, a company pays $60,000 for a 1-year advertising campaign, securing a year's worth of advertising services. Journal entries, initial, debit, prepaid advertising $60,000 represents the asset acquired, right to advertising services. Credit, cash $60,000 reflects the cash outflow for the payment. Monthly, debit, advertising expense $5,000 recognizes the expense for 1 month's worth of advertising services, $60,000, 12 months equals $5,000 per month. Credit, prepaid advertising $5,000 reduces the asset value by the amount of advertising services consumed during the month. Case study 2, prepaid rent for a business space. Scenario, a business pays $36,000 for a 6-month lease, securing the right to use a business space for that period. Journal entries, initial, debit, prepaid rent $36,000 represents the asset acquired, right to use the business space. Credit, cash $36,000 reflects the cash outflow for the payment. Monthly, debit, rent expense $6,000 recognizes the expense for 1 month's worth of rent, $36,000, 6 months equals $6,000 per month. Credit, prepaid rent $6,000 reduces the asset value by the amount of rental space usage during the month. Case study 3, prepaid maintenance contract. Scenario, a company pays $15,000 for a 3-month maintenance retainer, securing guaranteed maintenance services for that period. Journal entries, initial, debit, prepaid maintenance $15,000, represents the asset acquired, right to maintenance services. Credit, cash $15,000, reflects the cash outflow for the payment. Monthly, debit, maintenance expense $5,000, recognizes the expense for 1 month's worth of maintenance services. $15,000, 3 months equal $5,000 per month. Credit, prepaid maintenance $5,000, reduces the asset value by the amount of maintenance services consumed during the month. Prepaid expenses are payments made in advance for goods or services to be received in the future. These are important because they represent resources that will provide future economic benefits, affecting a company's financial health and reporting accuracy. The importance of prepaid expenses. First, prepaid expenses help match expenses with the revenue they generate, ensuring accurate profit measurement. Second, they provide insight into future obligations and resource allocations. Implications of prepaid expenses. First, overstating prepaid expenses can lead to an understatement of expenses and an overstatement of net income. Second, accurate recording and adjustment of prepaid expenses are crucial for financial statement reliability.